Hi there. Starting self-employment in Milton Keynes during 2026? We'll explain registration, record keeping, and your first UK self-assessment tax return.
Imagine this. You've just started taking on a few subcontracting jobs around Milton Keynes. Over the year, you earn £1,200, but you spend £400 on tools and travel to get the work done. So your actual profit is only £800. You don't need to register for taxes yet, right? Well, actually, wrong. This is exactly where so many new business owners get caught out. That £1,000 threshold you've probably heard about, it's based entirely on your gross trading income. That means before a single penny of expenses is deducted. A lot of people overlook this detail, but it's incredibly dangerous. HMRC's digital systems are getting more sophisticated every day, and they can easily flag sudden, undeclared business deposits hitting your personal bank account. Getting this wrong early on can lead to sudden, really stressful compliance audits and totally unnecessary penalties before your business has even truly taken off.
Hello and welcome. This explainer has been prepared by the expert team at Atlas Tax Advisors, or ATA for short. We're your trusted UK accounting firm, and we are completely dedicated to helping businesses understand tax compliance and navigate HMRC regulations without the panic. I'm a senior tax advisor here at ATA, and I'll be guiding you through today's topic. We're focusing on a very specific, absolutely crucial viewer today, a UK sole trader based in Milton Keynes whose gross income is crossing that magic £50,000 threshold. If that sounds like you really need to pay close attention. 2026 is the year literally everything changes. It is the biggest overhaul to the UK tax system in a generation, completely transforming how you report, when you report, and how you pay your taxes. So let's make sure you're fully prepared for what's coming.
Here is our agenda for today. 1. The registration reality check. 2. Making tax digital 2026. 3. The tax year basis. 4. National insurance for 2026. And finally, 5. Preparing your first return.
Section 1. The registration reality check. The core foundation of self-employment tax starts with just one number, £1,000. This is the UK trading allowance. Did you know that many taxpayers are completely unaware of how this rule actually works until they're already late preparing their first tax return? You absolutely must register as self-employed with HMRC if your gross income from self-employment exceeds £1,000 in a single tax year. And remember, gross income means every single pound that crosses your palm or enters your bank account before you pay for materials, tools, software, or fuel. Let's look at a practical scenario to put this into perspective. Say you sell $1,050 worth of consulting services, but you buy a $900 laptop to actually do the work. Your profit is just $150. But because your gross sales hit $1,050, the law strictly requires you to act and register. Once you cross that line, you are officially on HMRC's radar.
So when exactly do you need to tell them? Let's map out your timeline. Let's say you launch your Milton Keynes consultancy or contracting business sometime during the 2025/26 tax year. The UK tax year always ends strictly on the 5th of April, so that brings us to the 5th of April 2026. Your absolute statutory deadline to notify HMRC and register for a unique taxpayer reference is the 5th of October of your second tax year of trading. So in this specific scenario, that's the 5th of October 2026. Your unique taxpayer reference, or UTR, is a hugely important 10-digit number. It stays with you for life and acts as your primary identifier across all of HMRC's systems. Missing this October deadline is one of the most common ways new sole traders end up with completely unnecessary financial penalties before they've even filed a single tax return. Let's avoid that.
Section 2. Making tax digital 2026.
If you take away just one thing from this explainer today, it needs to be the sheer scale of this upcoming shift. Making tax digital for income tax self-assessment, usually just called MTD-ITSA, is entirely rewriting the rules. Under the old self-assessment system, you could practically keep your receipts in a shoebox or a messy spreadsheet and just file one big annual return by January. Well, that era is definitively ending. If your qualifying gross income, which means your combined turnover from all self-employment and property, is over £50,000, you fall squarely into Phase 1 of Making Tax Digital starting the 6th of April 2026. This new reality dictates that you must use HMRC-compatible software. In the real world, this means adopting cloud-based accounting apps that link directly to your business bank accounts to pull in live transaction data. Instead of one annual chore, you'll be submitting 4 quarterly digital updates throughout the year, plus one final declaration to tie the whole shebang together.
To really grasp the reality of making tax digital, we have to look at the new calendar. Here are the 4 strict quarterly reporting deadlines for the 2026-27 tax year. As you'll see, the deadlines consistently fall on the 7th of the month following the end of the standard tax quarter. So for example, Quarter 1 runs from the 6th of April to the 5th of July, which means your very first digital update is due by the 7th of August. Now, time for a professional tip. Keeping clear digital records week by week will save you immense stress here. And we really need to dispel a common fear right now. Submitting 4 updates does not mean you're paying your tax bill 4 times a year. These updates are simply cumulative summaries of your income and expenses. They aren't your final tax calculations. HMRC just expects this raw financial data to flow digitally, directly from your software to their systems, keeping them updated on how your business is performing in near real time.
Section 3. The tax year basis. Running right alongside the MTD rollout is another massive reform that changes how we measure time for tax purposes. Historically, sole traders had the flexibility to pick their own accounting year-end. You might have run your books up to December 31st or maybe September 30th, and you were taxed on the 12 months ending in the current tax year. That system is completely gone. The new tax year basis means all reporting now firmly aligns with the standard 6th of April to the 5th of April window, period. The practical impact here is significant. Take a Milton Keynes business owner who historically closed their books every December. Under these new rules, they now have to apportion months from 2 completely different accounting periods just to fit HMRC's April to April timeline. This removes the old, incredibly confusing concept of overlap profits, but it absolutely reinforces why having robust digital software is no longer just a nice-to-have, it's a strict necessity to calculate these apportionments accurately.
Section 4, National Insurance for 2026.
Next up, we need to talk about national insurance contributions, or NICs. This is an area where many people become confused, but I promise you, it's actually excellent news for most sole traders. Class 2 national insurance is no longer a compulsory cash payment for the vast majority of self-employed individuals. If your profits hit the small profits threshold of £7,105, your Class 2 NICs are automatically treated as paid. That means you protect your state pension and benefit records without actually handing over any physical cash to HMRC. However, if your profits fall under £7,105, you're exempt, but you can choose to make voluntary payments of £3.65 a week. Now, why would you do that? Well, because you need 35 qualifying years of national insurance contributions to receive a full UK state pension. Paying that $3.65 voluntarily is a brilliantly cheap, highly effective way to buy a year's pension credit and keep your future retirement totally secure.
So if Class 2 is mostly gone, where does the national insurance cost actually come from? That would be Class 4 national insurance. For our Milton Keynes sole trader earning over £50,000, you really need to understand exactly how this calculation works. For the 2026/27 tax year, you'll pay 6% on your profits, sitting between the lower profits limit of $12,570 and the upper profits limit of $50,270. Any profits stretching above that $50,270 mark drop down to a 2% charge. Let's do the math on a practical scenario. If you make $60,000 in profit, you pay 6% on that middle chunk between $12,570 and $50,270. Then, you pay just 2% on the final $9,730 that sits above the threshold. When you combine that 6% Class 4 rate with your standard 20% basic income tax rate, your marginal tax rate on profits in that middle band is 26%. This total liability is collected together alongside your income tax through your final self-assessment declaration.
Section 5, Preparing your first return. All right, we are now entering the final stage of the tax lifecycle, settling up your bill with HMRC. Under the new Making Tax Digital system, after your 4 quarterly updates are done, you'll submit an end-of-period statement followed closely by your final declaration to calculate the exact tax owed. Your final tax bill must be paid by the 31st of January following the end of the tax year. But as a tax advisor, I need to explicitly warn you about Step 4, the payment on account trap. This is a profound shock for almost every single new sole trader. HMRC assumes your business will perform just as well, if not better, next year. So on the 31st of January, they don't just ask for last year's tax. No, they also demand 50% of next year's estimated tax up front as your first payment on account. For instance, if your very first year's tax bill comes to £4,000, HMRC will also ask for £2,000 towards next year. So by January 31st, you don't just need £4,000 in the bank, you need £6,000. This sudden cash flow shock sinks many viable new businesses, which is exactly why meticulous planning is absolutely critical.
Bringing this all together, what is the core takeaway for your business? Going self-employed today requires adapting to a highly digital, highly structured tax environment. Whether you're a local contractor operating out of Bletchley or a fast-growing consultant right in central Milton Keynes, proactive financial management is your strongest asset. Staying ahead of the 1,000-pound gross rule,
Getting your digital software integrated long before the 2026 Making Tax Digital deadlines kick in, and fully understanding how your national insurance and payments on accounts are calculated, these steps will save you immense stress. This isn't just about avoiding HMRC penalties, it's about having total visibility over your finances, keeping vital cash flow inside your business, and positioning yourself to grow with absolute confidence.
Please remember, the information provided in this explainer is general guidance only. Tax laws are inherently complex, and your individual, specific business circumstances matter immensely. Viewers should always obtain professional advice before making any financial or tax decisions. If your business is crossing that £50,000 threshold and you're looking at the realities of implementing Making Tax Digital, you do not have to do this alone. We highly encourage you to reach out and contact us directly at Atlas Tax Advisors. We provide bespoke, professional accounting services tailored perfectly to your unique needs, ensuring you remain compliant and tax efficient. The tax landscape of 2026 is entirely digital. So my final question for you is your business actually ready for the leap? Thank you so much for watching, and we look forward to helping you thrive